Good day, guys. It's your mentor Pablo SMC. So, guys, today we are doing the strategy video. So, guys, I realized that teaching you guys a lot of strategies will confuse you, will lead to confusion, and not being consistent with one strategy and not choosing one model. So, guys, I decided to teach you guys the strategy that I am trading, instead of teaching you all the SMC strategies that I don't even use and others I don't even use anymore, you get. So I decided to teach you guys the strategy that I'm personally trading. So this is the name of the strategy, which is what? External range to internal range liquidity. The name of the strategy is ERL to IRL. So what is an ERL? An ERL is basically a break of structure of any trend. And an IRL is an order block, FVG, or breakable. IRL, it's not really a order block or FVG or breaker block. But then I am simplifying things for you guys to understand very well. So we're gonna identify our order blocks, FVGs, and breaker blocks as our internal range liquidities. So how do we trade the external range first? How do we trade the external range? Remember, guys, the strategy name is external range to internal range, meaning the market will move from external range to internal range, from internal range to external, from external to internal, from internal to external. So how do we trade the ERL first? External range liquidity first. Remember, the external range liquidity is basically an break of structure of any trend, whether it's bearish or bullish. So now let's talk about a bullish trend. How do we trade an ERL? So guys, remember, let's say this is our higher time frame, and this is our lower time frame. So how do we trade our ERL? So guys, immediately after the market breaks the structure, breaks the previous high and creates a break of structure, it forms a what? An external range liquidity. That's actually an external range liquidity. So we are expecting the market to come back to tap on the internal range liquidity. Remember, guys, it is a must for the market to tap on the internal range liquidity before pushing up. So how do we trade external? Now it's about external range, not internal range. On a bullish trend, how do we trade external range liquidity on a bullish trend? You basically gonna do this. Once the market takes or breaks the structure, once the market forms our break of structure, which is an external range liquidity, you're gonna wait for the market to create the change of structure, the market structure shift, change of character. I don't know how do you guys identify it, but then it's the same thing. What is a change of character? First, what is a change of character, guys? So I made few examples of a change of character or a market structure shift. So how do we trade? How do we take advantage of our bullish market structure shift and bearish? Remember, now we are focused on what? On this one, because of it's an external range liquidity. It happens after taking out the external range liquidity. So on a lower time frame, the market is moving like this. Yes, on a higher time frame, you're gonna see something like this, just a simple movement like this, up, down, up. But then on a lower time, once we go on a lower time frame, the trend is like this. Remember, the market has been buying here. Ne? Remember, the market has been bullish on a lower time frame. Then suddenly the market does what? Takes out the previous low and forms a what? A high. You understand? It takes out the previous low, then displaced it. Once it displaced, it goes up to our order block, FVG, or change of character, so that it can start doing what? Changing the trend of the market to a bearish trend. because this was what? A bullish trend on a lower time frame. This is an example of this. On a lower time frame, this has been like up and down, up and down, up and down. So here, this dotted line, it's basically a lower time frame. So you're only gonna look for what? For a change of character. After taking out the external range liquidity, you're only gonna look for change of characters to the downside. To where? To the internal range liquidity. So once you tap on the internal range liquidity, how do we trade internal range liquidity from trading the external range liquidity? You understand? How do we trade internal range liquidity? Remember, this is a bullish trend. So after tapping on the internal range liquidity, which is your what? Your order block, FVG or breaker block. How do you trade from the internal range liquidity? Let's say you marked out your what? Your breaker, your order block or your FVG. Once the market taps on the FVG, the market has to do what? Has to create the market structure shift, which is a bullish market structure shift. What is an example of a bullish market structure shift? Something like this. The market has been selling. Remember, the market has been selling here. This trend has been selling, which is this trend. The market has been selling down, up, down, up, down. Then it takes out what? It takes out our previous high, which forms a what? A market structure shift, because it forms a new high, then it forms a low, then it breaks a structure again. So which is a bullish trend now from a bearish trend that comes from the external range liquidity. So now we tapped on the internal range, we form a market structure shift, tap on the order block, then stop loss below the previous low, the current low, then you target the what? The new external range liquidity. So how do you trade the internal range liquidity? Once the market taps here on the internal, you need to look for a market structure shift to the upside, And what is your target? Your target is your new external range liquidity that is going to be formed. You understand? So basically you are predicting based on the upcoming that, okay, there's a new external range liquidity that is about to get formed, so it's gonna be your target. So this is how you basically trade the strategy, internal to external. So basically, if I can explain the strategy very easily, this is how you're gonna trade the strategy from low to high to low, which is internal range liquidity. We take out, then we form a what? External range liquidity, market structure shift on a lower time frame. Then we target internal range liquidity. Then we go up again from internal range liquidity. We look for another market structure shift. Then we target what? We target then this new external range liquidity. Then we do what? You look for another change of structure. You target the new internal range. So that's how you're gonna trade, which is ups and downs. Same thing happens on a what? On a bearish trend. So if you guys want an example on bearish markets, you can tell me, but I think you guys will understand this. An opposite of this, it's a bearish trend. So this one, it's a bullish trend. So the same things are gonna happen on a bearish trend. So this is how we trade the strategy that I personally trade. You're gonna look for what? Internal to external, external to internal, internal to external, until by following the trend, because it's a must. The market moves with lows and highs and highs and lows. You understand? So you have to find your lows and you have to find your highs. You understand? So that is exactly how we trade from external to internal, from internal to external. So this is the name of the strategy, and this is how we trade the strategy. I hope you guys understand. If you guys don't understand anything, come back, inbox me, then let's talk and let's have a session, and let me explain everything if you don't understand. So guys, this is the strategy. I think I'm done. I will send the video of chart examples so that you guys can see how we trade it on the charts. Thank you.